Coming up on the SBS On The Money podcast, we have a special interview with Origin Energy CEO Frank Calabria. Reporting season kicks on. We'll take a closer look at that. And Australia's jobless rate has fallen. What does it mean for interest rates? All those details and more next. Hi everyone, welcome to the SBS On The Money podcast for this Thursday, the 14th of August 2025. It's a day where the Australian share market just narrowly missed, hitting a record high close. It finished up 0.5% on the S&P ASX 200, 8,873. We'll have the details soon with Damien Boey from Wilson Asset Management, and we'll also speak with Justin Smirk on a fall in Australia's jobless rate. He's from Westpac. But we'll start with Origin Energy. It's Australia's largest energy retailer, so it has an idea on where electricity prices are going. It posted a 6% rise in full-year profit on higher revenues, and its shares increased 6% as a result. So to talk about its results, the economy, the energy transition, and where power prices are going, I spoke with Origin Energy CEO Frank Calabria. Frank, first of all, it seems like the market likes your results and a small beat on guidance. I saw in an analyst's note this morning the comment that investors will now be looking for the next lever to take the stock higher. What's that lever?
We've got a lot going on in our business and in the energy transition. So I think that where that could come from is that we've got to successfully execute on the growth in our energy markets business. That's probably one lever, and investing more into the transition. And then secondly, I think really people are very focused on our investment in the UK of Kraken and Octopus and the separation of those businesses. So I've had a lot of interest in that business. Very exciting. Two businesses. One's a technology business that serves the utilities market, but the other is an energy business that's got a wonderful brand and growing globally. So I think it'll be across those two areas of the business that we've got to continue to deliver more.
I'm keen to get your analysis on the local economy and especially the Australian consumer at the moment. We know that government subsidies for electricity are starting to roll off, but even with those subsidies, how much did you have to offer or help customers, and how?
You've picked on one of the most key issues that we think about in our business, because cost of living is probably the number one, not probably, it is the number one issue, and we're acutely aware that many households, are struggling to make ends meet, and particularly those that are in hardship. So over the last 12 months, we've invested sort of $38 million supporting customers in hardship. But it goes to how you interact with your customers every single day and making sure they're on the right plans, the right products, the right and that the right contracts. So we do invest a fair bit of money into that, but also resource and engaging with the community. It's critically important. It is the number one issue, as I say, that's occupying the minds of customers across Australia.
I know that investors love some sort of guidance when it comes to outlook in terms of earnings, right? But what about the consumer, right? What kind of guidance can you give them in terms of what they can expect their electricity or gas bill to look like over the next year? Can you give us an idea of what they need to budget for percentage-wise, perhaps, of what you expect electricity prices at the retail level will go?
Yeah, it's just a little early, and I do say that to everyone that's listening that's a consumer as well, because they'll be set by July next year. And just to put in perspective what drives the electricity price, there'll be two things. There'll be the two key components will be the wholesale price for electricity, and then there will be the transmission and distribution charges. If we're looking at the wholesale electricity price today, at least as it informs, but next July, it's got some way to run, that is looking reasonably flat year on year. But we shouldn't underestimate the fact that there's quite a lot of investment going on in the market, in the enabling infrastructure. And so therefore I would expect to see some upward pressure on that. I can't give you a percentage on that, but I would expect to see that. It's certainly on the minds of all of us, policymakers, governments, because we are really trying to work hard at not having those price rises. But there is also an enormous undertaking going on right now to deliver on the energy transition as we build out a new transmission, particularly new transmission network. So that's the best indication I can give you now, but it's pretty early in terms of predicting what will happen in July next year.
But prices will still rise.
Yeah. Well, I think so. I think in terms of the amount of investment that's going on into the energy system, it's hard for that not to be recovered ultimately. But the extent to which that percentage increase now is, I don't really have a good handle on yet. Yeah.
Okay. You said another key term, that energy transition. What do you see as the biggest obstacle to it? And I know it's complex. What's the key message you want to send to decision makers, especially as we head into next week's economic roundtable on productivity?
You're spot on. I mean, the fact is that firstly, I think to everyone that's listening and watching here, that it's an enormous undertaking. Like, it is really a very significant, because you're essentially replacing the energy system. The key things for the economic roundtable next year is that an effective execution of that transition needs to have the consumer in mind, because not only do we have to achieve emissions reduction, but we do need to make sure that we have affordability and reliability of that system in mind when we do that. The key messages are the following. The government has been given a strong vote by the public to deliver on this transition, but we need to bring the consumer along. And the key policy areas for us to actually deliver on that productivity is there's a wholesale energy market review, which enables us to invest with confidence. Secondly, there's a gas market review, and something people would understand is broader than energy. It's the planning approvals that need to go forward. If they can be done, if they can be implemented, people will invest with confidence, but then more importantly, it'll be the most efficient way of delivering the energy transition, and that's most important at the moment. But we do need to keep in mind that we have to deliver on keeping affordability, reliability, and the emissions reduction, and that's the challenge that needs to be faced into.
Final question. And you're also in the EV space. There's talk of a possible road user charge for EVs. What are your thoughts?
Oh, look, we obviously are in the EV space, and we very proudly have a business that offers EVs to many, many people across Australia, and that's growing. I've seen the announcement about the increase in the surcharge that's coming in. I just encourage that everyone gets the balance of that right, because we still want to see the adoption of EVs over time and as they come into the system. But I truly appreciate that the Treasurer is trying to balance those. But, we'd like to continue to see the adoption of that over time. And we think that lots of customers are enjoying the benefits of that, particularly in urban markets. But that they need to balance the interests of many constituents when they make choices like that.
That's Frank Calabria there, the CEO of Origin Energy. Let's take a look at the Australian share market now, which just missed hitting a record high at the close. The S&P ASX 200 up 0.5% to 8,873. 7 of the 11 sectors ended higher. Utilities, the best performer, are driven by Origin Energy. Utilities up by 3%, followed by financials and consumer discretionary. The worst performing sector, telecommunication services, down 1%. If we take a quick look at the best performers and the worst performers, the best, Temple and Webster, up 7.9% on the S&P ASX 200, followed by Pro Medicus and Origin Energy. Westpac also had a great day, up 5.8% today. In terms of the worst performers on the market, Liontown Resources down 7%, South 32 off by 5.3%. Rio Tinto also not having a good day. For his take on the day's market action, as the market closed just behind a record high, I spoke with Damien Boey, a market strategist at Wilson Asset Management. Damien, the ASX is at a record. What's driving investor sentiment at the moment?
I think investors are really looking for rate cuts all around the world. So we've had comments, for example, from US Treasury Secretary Besant, who's encouraging the Fed to cut 1.5 to 1.75%. We've also seen that the Reserve Bank of Australia has recently cut rates and, if anything, guided towards more. So it feels like the market is celebrating rate cuts at the moment.
But what about the ongoing geopolitical risks, right? Are investors, to an extent, brushing those aside because shares in the US, as we mentioned earlier, are also at a record high?
Yeah, so I think the geopolitics matter, obviously, but we need to find a point that the uncertainty from geopolitics actually transmits over to markets or the real economy. And so far, it seems like investors are still kind of feeling around for that. For example, if we go back to Liberation Day, obviously that was an episode of enormous uncertainty, but yet markets seem to sail through that quite comfortably because there wasn't a trigger for high uncertainty to create funding stresses in the economy or nor even drive down confidence in a really big way. So right now we're looking for that point that uncertainty transmits to financial markets. We had a go at that with obviously all the tension that was there with Iran. Temporarily, oil prices went up. That could have been a shock, but eventually that also unfolded. So right now there's nothing really to dissuade investors from just continuing to look forward to rate cuts as a panacea for a lot of the issues out there in the world.
It's a really busy reporting day today. I'm looking through at the moment Telstra, ASX, Origin Energy. You've got some smaller companies as well. You tell me, which of the corporate results are you following and why?
Yeah, so the Westpac result is really interesting. Obviously, the net interest margin result that they've got there has surprised a little bit to the upside. Origin has managed to, give a small beat when it comes to guidance, which is what a utility can do. Temple Webster, I think, is another really interesting result. Just continuing to show that consumer sector is actually quite robust. Telstra obviously was a little bit disappointing. Investors expected more. But I guess the broad flavor of all of this, and this extends to some of the results that we've seen in previous days as well, is that if you're a real crowd favorite name, like say a CBA or a JB Hi-Fi or one of those sorts of stocks, which has really run up quite hard in the last 6 to 12 months, investors really are expecting a lot from you. And if you're not actually able to deliver that, even a little bit of disappointment or the absence of a positive surprise could actually be a catalyst for some repositioning of flows. So we are looking very closely at the positioning and what the share price responses to reactions are telling us about that. But also we're looking at simply the strength of the domestic economy because we think that the RBA in cutting rates may actually be overstimulating the economy.
Um, Are there any broad themes to come out of reporting season? When I speak to analysts every day for the podcast, they pretty consistently tell me they want to know three things from companies in commentary: how the consumer's feeling, the international outlook, and what companies are doing with AI, for example. But what are you seeing as the key themes?
Yeah, so as I was saying before, the key driver of markets right now is the interest rate outlook. You could make an argument that maybe investors are obsessing about interest rates maybe a little bit too much, but it is what it is. So we're interested basically in seeing whether the broader economy is actually holding up quite well, and if there's any evidence to suggest that we should be believing in lower rates or higher rates. That's really what we're after. So when we see, for example, real resilience in the consumer sector, but yet the RBA is continuing to cut rates, that is actually a real message here that A, the cycle is really good, which is positive for cyclical equities, but B, the discount rate that we're applying to future cash flows is also being capped or limited in some way, which also is very good for equities. So that's kind of what we're looking for. On the flip side, what we'd be really interested to see is whether policymakers actually respond to some of the trading updates that we're getting throughout reporting season, particularly from the consumer. So are we seeing labor cost inflation? Are we seeing pricing power? And most importantly, is the consumer actually holding up much better than initially feared?
And finally, what are you telling your clients right now, and where do you see the opportunities for investors?
Yeah, so there is a lot of opportunity. Right now, we think that no matter whether the data are printing strong or weak, there seems to be this force which is suppressing bond yields. And to the extent that you're suppressing bond yields, that's being celebrated by the equity market. And the way that you would position for that is essentially through a lot of growth type stocks. So that's kind of the short-term solution. However, longer term, what we are watching at the moment is usually when central banks cut rates and they're going a little bit in the opposite direction to what fundamentals are suggesting, there is a little bit of a hit to credibility. You should actually be seeing a bit of a risk premium getting built into bond yields, i.e. bond yields going up. that could actually be a signal for quite a lot of positioning to change, because as I mentioned at the outset, everybody's kind of going all in on the idea of lower for longer rates via those long duration growth stocks. So we think that there's a little bit more to go in the growth thematic, but we are keenly looking out for any inflection point that might suggest going back to short duration dividends or value.
It's Damien Boey there from Wilson Asset Management. Now to some economic news, because it looks like borrowers looking for a follow-up interest rate cut at the next RBA meeting may be disappointed, although obviously that's good news for savers, because the Bureau of Statistics says the July unemployment rate fell from 4.3 to 4.2%. There was a rise in full-time employment driven by females, and while the participation rate, that's a proportion of people in work or looking for work, remained at 67%, female participation hit a record high. To tell us what this means for interest rates and what it says about the economy, I spoke with Justin Smirk, a senior economist at Westpac. Justin, what does the labour force data today say about the jobs market at the moment? Because we've seen a fall in the unemployment rate.
You're quite right there, Ricardo. We did see the unemployment rate fall back a little bit to 4.2%, and that's a little bit below what the RBA has been talking about. But it's still showing us this sort of gradual weakening trend in the labour market. It's still showing that the market is robust and that it's still quite got an underlying strength. But what we're also noticing is this rise in youth unemployment, which has perhaps been the most noticeable one. Youth unemployment, most marginally attached to the labour force, it's been rising in a trend sense over the last few months. It did pull back this month, but it's still on an upward trend. So that's the warning sign that while the labour market is still strong and it's still holding together, there's signs where it may be getting a little bit weaker.
What is driving the jobs growth at the moment? We saw that full-time jobs really drove the result this time round.
Yep. And also if you dive into it too, you can see that it was female full-time jobs that were the most concentrated there. And that's giving us a hint that it's still really coming through this public sector, care economy, the side of the economy that's still growing in relationship to all the care services. And that's still sort of the critical underlying driver. And what we're wanting to see is that switch. It's going to be a transition over the next 12 months, and that'll be important, just how we transition as that care economy growth slows, not go backwards, just slows, and do we get the take up in the market sector.
What about female participation? That's at a record. What does this show?
Well, it's actually showing that there's some underlying two things are happening. We're seeing lots of women coming back into the workforce, more women working longer, women coming back from having children, more going into. So overall, you can see the supply of labour from women is actually improving and growing. But also what we're seeing is the jobs being created are predominantly in sectors that are very strong for females. So there actually is a very strong demand story here. So while there's strong demand for labour, we're pulling women into the workforce as well. The reason I highlight this is as we get softer demand, it's quite likely that female participation could flatten out or even drop a little bit as the demand falls away, not necessarily because there's less women wanting to enter the workforce, just because there aren't as many jobs and such. There's the draw of pulling women into the labour force that we're seeing right now.
You're speaking about the future and the next 12 months, right? What do future indicators of the jobs market say? How do they look?
Well, they are looking softer. Again, it's in relative sense, they're stronger than what we've seen sort of even during the pre-COVID period. But the jobs ads, the job vacancy numbers, business surveys, are firms still thinking about employing? Are firms still finding it hard to find employment? That last one is quite critical. Even though it's improved, firms overall are still saying it's relatively harder than usual to find employees. That tells you demand for labour is still stronger than supply.
So finally, we know that the RBA is expected to continue cutting interest rates, but is it fair to say that following these results today and the data that the RBA is not necessarily in any rush to cut rates? Should borrowers expect, back-to-back rate cuts, for example, from the RBA?
I think we have to take the RBA on the word on this one, and they're saying they want to be cautious about the rate cuts. Yes, the Reserve Bank governor did talk about the potential for 2 or maybe even more rate cuts going forward, but she said it in a very cautious tone. And it's pretty critical to remember what we're talking about here is easing rates from being in a restrictive stance back to a more neutral stance. And that is because the economy is becoming more balanced. They no longer have to be restrictive. We're not talking about a situation where we're staring down the barrel of a potential recession or a big collapse in demand. It's more just trying to recalibrate the economy. As such, we think the RBA does have 3 more rate cuts, but it's going to be very gradual. 1 more this year after the November CPI, and then 2 more next year after each CPI announcement on the quarter.
It's Justin Smirk there from Westpac. And it wraps up the podcast for this Thursday. Tomorrow we've got Cochlear's CEO scheduled in. And will the market hit a record high? We'll find out then. Remember to give this podcast a rating or a review on Apple Podcasts or Spotify if you enjoy it, and to click subscribe. See you tomorrow. This SBS on the Money podcast is provided for informational purposes only and should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.